Hi, everyone. Hope everyone's enjoying their summer. So we have John, I see you. Sorry, I'm just scanning to there are so many faces. And Connor, welcome, and Doug, welcome. So you guys are first up on the agenda for a review of the portfolio. So I'll pass it over to you guys.
Certainly. Thank you so much, Kelly, and thank you everyone for having us here. Hope you're having a nice summer so far. The sad thing is I feel like by the time we get past 4th of July, it feels like the summer's almost over. So we got to enjoy these last 6 months or 6 weeks or so while we got them. But it's been since April since we last met with you all. So I was just going to give a few quick updates on the firm before handing it over to John to go through performance review. It was a somewhat challenged quarter on the equity front, but for the year, for your fiscal year, we remained comfortably ahead of our benchmark. So happy to report that. But Karen's asked me to share my screen, so I will do that now. Let's see, share. And let me know if you can see this.
We can.
Yes, we can.
Perfect. Okay, great. Well, yeah, thanks again. My name's Connor Watson. On the Public and Taft-Hartley Fund team here at Boston Partners. You'll know John Forelli and Doug Rossi. John is our head of portfolio research. He just passed his 14-year anniversary with Boston Partners, and Doug is the client service associate on this relationship between Doug and myself. We're handling the day-to-day requests that are often coming from Karen and Jen and making sure that we get things to you all in a timely manner. If we jump to page 4, you'll see a new graphic, but it's the same information. We just have sort of a new design here. This is Boston Partners. We are a value-focused equity manager founded back in 1995. As of the end of last quarter, just based on the book production turnaround here, our assets were 103 billion. That ticked down to about 101 billion as of the end of the second quarter. That was largely due to market movements, and we've actually seen a lot of interest and a lot of positive net inflows, which we're very happy to report. You may remember that Boston Partners only invests one way across all of our different value equity strategies. You can see those there in the bottom right, broken out by AUM. Again, those are also as of the end of the first quarter, but you'll see the premium equity strategy, which you all use for your equity allocation at 11.4 billion as of the end of last quarter. That was 10.7 billion as of the end of the second quarter. That single strategy and approach that Boston Partners uses has served us well over the years. All of our strategies have been able to beat their benchmark on a net of fees basis going back to inception. That's what you're looking for out of an active equity manager. So happy to report that. The next page just sort of underlines that point. The numbers in the boxes you're seeing are the value add that we've been able to achieve. So when you look at premium equity for the 1 year, for example, that's as of the first quarter, the 2.78% means that we've been able to beat the benchmark by that amount net of fees. So after all the fees and expenses have been taken out. Again, this is as of the end of the first quarter, but for the second quarter, those numbers for your strategy continue to be all green, all beating the benchmark. Nothing red for premium equity there. Page 6 is another page that we snazzed up a little bit from a graphic standpoint. This is the Public and Taft-Hartley Fund team covering all of our public and Taft-Hartley relationships across the country. You'll see myself and Doug on this page. We continue to be a very important part of Boston Partners' core business with 12.6 billion in assets under management within our group here. Page 7 is just representative clients. We thank you again for allowing us to use your name when we're out there in the market. Page 8 here is the investment team. On the left-hand side in the blue box, you'll see our portfolio managers and portfolio research. including John Ferrelli there. Also, you'll see Dulio Ramallo, who is your portfolio manager for the premium equity strategy. No changes to note here. Dulio's been portfolio manager on the strategy since 2005. The middle box here are our investment analysts. They're the ones who are really digging in on the names on both a quantitative and fundamental basis. The group is very experienced, 17 years of experience on average. The only thing to note here is we recently added a new resource. We added a new equity analyst, Meg Zona. We brought her over from Goldman Sachs, and she will, I think she's starting in the next couple of days, so it's a little bit of a forward news here, but she's going to be helping out Andy Hayden on the healthcare front. Why don't I pause there, see if there's any questions on the firm updates? And if not, I'll ask John to jump in here, and we can get to that performance I mentioned, as well as positioning and what we're seeing out there in the market. Great.
Thanks, Connor. And we'll move to page 10, which is the performance of your funds on the subsequent pages as well. You can see for the second quarter, your total fund was down 2% compared to about 1.1% for the benchmark, being 50% the Russell 3000 value and 50% the fixed income benchmark, compared to so we did underperform by about 90 basis points for the second quarter. The combination of both our equity stock selection as well as being overweight equities in a quarter where the equity returns were negative hurt the performance of the portfolio. But overall, the overall fund has basically matched the benchmark on a year-to-date basis. And 1 year, I believe your fiscal year end is 6/30. Is that correct? And for your fiscal year ending 6/30, we've outperformed by about 100 basis points relative to that benchmark, 875 versus 778. So again, relatively strong returns for a balanced account. And then you can see the longer term comparisons, and going out back to inception, we're about 1.8% ahead of that benchmark with your fund. From the equity standpoint, the equity drove the returns on a 1 year basis, returning about 13.5% compared to about 12.9% for the benchmark. And again, it's very strong equity returns over the history of the fund, beating the benchmark by about 2.4% out to inception, which is now, we started with you back in 2005. So we're 19 years now into this relationship. And you can see fixed income matching the benchmark over this time period, which is exactly what we're trying to do, investing in the BlackRock Bond ETF and the Vanguard Bond ETF. And Kelly, I think I remember last time you were asking how the fixed income is done relative to the benchmark over that time period. And we've been in these ETFs for about 7 years. I think we started in November of 2017. And over that time period, you basically matched the benchmark, not only from a return standpoint, but also the median manager. I think one of your funds is in the 51st percentile, and the other one's in the 48th percentile. So you're kind of hopefully you're meeting that objective of what you've accomplished by buying these ETFs for the fixed income allocation. We will see similar returns on page 11 for the police fund as well. And on page 12, we can see the OPEB returns as well, which they date back to 2017. So about 7 years that we've been managing the OPEB funds as well. And again, positive comparisons versus the benchmarks over all those time periods. And similar 1 year and year-to-date performance that I discussed earlier with the pension fund, the town pension fund. On page 13, gives you a compilation of all the assets that we manage for you. $110 million are in the town of employee pension fund, $60 million in the police pension fund, and the OPEB funds altogether have about $182 million with us that we're managing for you. what's interesting to note is that over this time period, with all those four accounts, aggregating those four accounts, you've invested about $58 million with us all together. Over the course of our relationship, you've withdrawn about $30 million for a net investment of about $28 million with us. And that $28 million is now worth $182 million. So we've made about 6.5 times your initial investment over that 19-year period. So that's hopefully, again, meeting your financial objectives for your beneficiaries. On page 14, we can see the equity allocation versus the fixed income allocation. As I said, over this most recent quarter, being overweight equities did hurt the portfolio. On a quarter-to-date basis, the equity market's been very strong here over the last week or so. The market, your portfolio is up about 4% on a quarter-to-date basis. So we kind of made back whatever we lost in the second quarter. But we're about 55% allocated to equities right now. You may remember that we were maximum overweight equities for a long time. About 2 years ago, we began trimming back that equity maximum position from 60% to 55% today. And we'll continue to look at the risk return versus both portfolios. I would say in general, when the 10-year bond yield is below 5%, it's difficult for us to be overweight fixed income unless we had some sort of a view that the equity market was in near-term disarray for some reason or another. So would not surprise me if we remained overweight equities in the near term. The valuation of the equity market does not look inexpensive relative to history, that's for sure. That's mostly isolated towards the growth portion of the U.S. market as opposed to the value portion of the U.S. market. And then in addition to that, we're in an environment right now where we would expect the Fed to begin cutting rates sometime in the second half of this year. Probably September would be when they begin. At the same time, we're expecting inflation to continue to trickle down. And that's typically an environment that favors equities, and you'll see multiple expansion in the equity market. So again, it seems where we sit today, it's prudent to be overweight equities in your portfolio, despite the fact that the overall equity markets in the U.S. look expensive. And Connor, just to drive home this point, if I could ask you to turn to page 28, just briefly. And page 28 here shows in the green bar the current median PE of different portions of the U.S. market, and the blue bar is the historical average back to 1982. So we're looking at over 40 years of history. And as you look at this chart, you can see on the left-hand side, the green bar is above the blue bar, meaning that growth stocks today look expensive relative to history. And on the right-hand side of the page, you can see that green bar being equal to or below that of the blue bar, meaning value stocks look inexpensive relative to history. So that's when, I make that comment that said the overall market looks expensive based upon the left-hand side of this page, but the portion of the market that we focus on, the right-hand side of the page, still looks attractively valued to us, and we're not having any shortage of finding new opportunities for your portfolio today.
Hey, John.
Yes.
Hey, this is Eric Bauermeister. I'm going to ask the same variant of a question I keep asking because I'm still curious. What is the spark that is finally going to make the value growth gap close? Like, what is it going to take? Is it a bear market so growth gets killed and value outperforms and holds up better? Is it the interest rate cycle? Like, what's it going to take to really change this dynamic that has been so prevalent?
Yeah, it's a great question, and I wish I had the answer for you. What I can do is I can kind of speculate what I think would have an impact on it. I do think what we're seeing with interest rates today is affecting value versus growth. So over the last 2 weeks, we've seen the encouragement that the Fed's going to begin cutting rates sooner than maybe previously expected. And we've seen a big rebound in the value market relative to growth over that time period. Today, I'll just use as an anecdote. This is not a trend that it makes, but today we're seeing value outperform growth by about 1.5% today. And that's a very big move. And that coincides with, I guess, a couple of expectations in the marketplace today. One is that the Fed will begin cutting rates in the second half of the year. The other expectation is that inflation will continue to trend downward in the near term. And the third expectation is likely that we might have a Republican domination of the electoral events in November. And as a result of that, there's some speculation that the economy will continue to maintain its leadership. And in that environment, we might see a higher long-term rates for longer, even though the short-term part of the curve might be coming down. And I'm talking to a fixed income guy, so you know all about yield curve. And if we start seeing a positively sloping yield curve, we believe that would be positive for value over growth, as investors will discount those growth earnings at a higher rate because they're further out into the future, relative to value stocks where you get more of those cash flows near term relative to growth stocks.
So you don't think it won't require a bear market, or maybe it's a sideways market?
Yeah, maybe it's just a sideways market. The last time we had this abrupt change from value to growth was in 2000, and about 2000 is really when it started, right? When the tech bubble burst. We did end up having a recession later on, about 12 months later in 2001 was a mild recession. But there we just had a point where, trees can't grow to the sky. And I think investors just kind of woke up to the fact that that there are other portions in the market to invest in that might provide some nice returns. And we've started to see it in this market with NVIDIA having, for a nanosecond become the most valuable company in the world. And then it has fallen off since then. And there's been a lot of analogies to that stock with Cisco back in 1999, 2000, which was the stock to own back then. And then it underperformed for about the next 15 years or so. So we'll see. Hopefully it doesn't require a bear market. And it's just more of a normalization of valuations based upon really the law of the investment laws of physics of fixed income versus equities and where appropriate valuations lie.
Thanks.
Okay. If we turn back to page 15, just a quick reminder in our 3 circles process, we're creating portfolios for you with lower valuation, better business fundamentals, and improving business momentum. We score each of the stocks in our universe. For this portfolio, we evaluate about 3,500 companies weekly. Quantitatively, we give them a score. Stocks on the top 30% of that rank list really become the area where our fundamental research analysts do their work, trying to find whether these companies also have those characteristics from a fundamental standpoint, not only from a quantitative standpoint. It's a process that we've been using for a long time here at Boston Partners, and one that we've been using for you since the inception of our relationship. And to see how that has worked in your portfolio recently, on page 16, you can see the valuation of your portfolio. So in the valuation circle, focus on PE FY1. That would be the PE ratio based upon 2025 expected earnings. So that's out about 18 months from now. Portfolio trades at really a relatively modest 13 times earnings compared to 20 times for the S&P 500. So you can see that we have a portfolio that's on average, about 50% less expensive than the market as a whole, with a much higher free cash flow yield. So certainly have the valuation characteristics that we're looking for. Fundamentally, we're not sacrificing quality when we create that portfolio. Very high operating returns on assets and returns on equity relative to the benchmarks there. And then business momentum, which is really beginning to pick up. It had ebbed a little bit towards the fourth quarter of last year. Business momentum is now 84% of your holdings have met or exceeded our earnings expectations in the most recent first quarter of 2024. And that's up from 72% during the fourth quarter of 2023. So business momentum is beginning to pick up across the value market. On page 17, we can see how we rank relative to a capitalization within the portfolio. As a reminder, this is an all-cap portfolio, so we will participate in small, mid, and large cap stocks in the portfolio. Relative to history, we're a bit underweight large cap stocks, which is really the most favorites among investors today. where we'd be overweight mid-cap stocks, which would be the green line, and then small cap stocks were a bit overweight relative to where we've been over the last, say, decade or so. So a little bit more opportunity in small and mid cap, a little bit less opportunity in large cap today on a relative basis. And I think, as you're aware, small cap stocks have by far underperformed the mega cap stocks here over the last 5 years, and that's providing that opportunity for us in the portfolio. On page 18, you can see how your portfolio is currently positioned today on the equity side. Premium equity portfolio, the top 10 positions make up 20% of the portfolio. A full position in this portfolio is somewhere between 2 to 2.5%. If a company like Alphabet has outperformed like it has, we'll let it go up to about a 3% position, and then we'll typically cut that back in the portfolio, which we have done so far in the current quarter that we're in right now. You can see in the lower left-hand corner, you currently have 113 holdings. You typically have anywhere between 110 and 130 holdings in this portfolio, with a turnover over the last 12 months of about 20%. That turnover percentage usually ranges somewhere between 20 and 40% in your portfolio. On the right-hand side, you can see how we're positioned relative to the benchmark. I draw your attention to the blue bar, which is your portfolio, compared to the green bar, the Russell 3000 Value Benchmark. And as we go down, you can see we're overweight communication services, healthcare, and technology in your portfolio, underweight real estate and utilities, consumer staples, and energy. Energy is an area where we had been more like market weight for you maybe 6 months ago, but as the price of oil approached $90 a barrel, and the free cash flow generated by the energy companies became a little less abundant than we previously expected, due to the fact that service costs were going up and a little bit more production. We've cut back that energy position in the portfolio. Technology is an area that's certainly been strong, not only in your portfolio, but for the market as a whole. We have software companies like Oracle in your portfolio. Interesting, you talk a little bit about AI here for a minute. The pure plays in AI would be companies like NVIDIA, if you're familiar with that name. Way too expensive for us, for our valuation disciplines here at Boston Partners, but we're looking for derivative plays in AI. And eventually this AI data has to be stored and it has to be managed. And Oracle is beginning to see new contracts from AI-related companies that will help accelerate their revenue in 2025. So these are more appropriately valued ways to play the trend in AI, which we do believe is a real trend, but it may take a little bit longer for those applications to come than maybe some investors are expecting right now. And lastly, healthcare is another big overweight in your portfolio. We like to see that stability of earnings in your portfolio for a portion of the portfolio, and healthcare looks a lot more attractive to us relative to real estate or utilities or consumer staples. Those are all more expensive portions of the market, and healthcare has much better growth potential. Health insurance and drug distributors are two of our favorite areas within healthcare. And then in addition to that, pharmaceuticals and some established biotech companies, very good free cash flow yields there. They're struggling a little bit for revenue growth, but we're certainly, they earn a spot in our portfolio as we believe those pipelines will develop over the next few years. Any questions on the portfolio positioning? Okay. Page 19, you can just look at your own leisure. That's your holdings, color-coded by recent transactions. A green diamond would be a new addition to the portfolio. An orange circle would be a new elimination. Up arrow would be adding to an existing position, and a down arrow would be trimming an existing position. Fair amount of colors on there. It equates to about 7% turnover for your portfolio for the quarter. And then on page 20, you can see how the growth of $30 million has grown since 2005, since we began our relationship. You initially invested about $30 million with us in equities between the pension account and the police pension and the town pension accounts. And that $30 million has now grown to about 204 million, assuming you didn't withdraw any money, which I know is a big assumption. But relative to the Russell 3000 value, we've added about $73 million of excess return on an initial $30 million investment on a net of fee basis. So at the end of the day, hopefully that's what you hire us for, is to create those excess returns for you and your beneficiaries. And then just other ways to look at our performance in different environments. On page 21, we can see this is since inception of this strategy. So this goes back to 1995 when we started this strategy 29 years ago. And you can see in months when the market's down, we've done a nice job of protecting capital 69% of the time. So just bring it back to the beginning of the presentation. We did underperform in a down market. That's relatively unusual for us. 69% of the time we have protected capital in down markets. In up markets, we've outperformed about half the time for an overall batting average of 57%. I guess if you were an NBA free throw shooter with 57% average, that wouldn't be too hot. But if your 3-point percentage was 57%, that's something that you certainly want to highlight. And compared to the competition, I think we stack up pretty well. On page 22, you can see how we rank since inception from a return standpoint. 12.2% net of fees puts us in the 6th percentile. Our information ratio, or risk-adjusted return, puts us in the 1st percentile, meaning we take less risk than the average manager out there to create those excess returns. And that batting average, which I mentioned earlier, puts us in the 1st percentile of all managers over that time period. So, simply put, our goal for you and for all of our clients is to create excess returns on a consistent basis. And I think we've stacked up pretty well relative to the competition with this strategy. And I'll take a break there and see if you have any questions on the portfolio or the market outlook going forward, or anything else I can help you with.
Does anyone have any questions? John, I guess you guys were very thorough. It doesn't seem that there are any questions.
Okay.
I guess just one, you did touch on it with regard to some of the expectations that are in the market, and you touched on sort of November. Any things that you have your eye on in the portfolio, just given that this, an election year, presidential election years can have a lot of choppiness to them, or any other things that you think that we should know about the portfolio and prepare for over the coming months?
Sure. So, when you think about what might happen, and again, we're not political pundits, okay? So we're just trying to go along with where expectations are today. And the expectations, generally speaking, in the market today is that it will be a Republican will win the presidential election. As a result of that, we'd expect probably more tariffs to come into play. And so we have to be very careful about companies that first of all, sell into China to some degree to see if there'd be any retaliation there. And then also what basic materials type companies might benefit from increased tariffs from overseas. So that's one thing to think about portfolio positioning. Nothing that we're changing the portfolio today, but something that we need to be mindful of. When it comes to a presidential election, you always have to think about healthcare, health insurance. It's been an area that's actually companies have had fairly good, robust earnings this year, but the stocks have not done that well, on expectation that there might be some change around reimbursement with Medicare and Medicaid rates for health insurance companies. Typically, the bark is worse than the bite, and they don't get much of a change in legislation. So as a result, we're actually looking to probably add to some of those positions as we get closer to the election. We could see a bounce in some of those names. And then finally, the defense area, which we're pretty well positioned in this portfolio. I don't think it really matters who wins the election. I think you're going to continue to see an increase in defense spending, not only in the U.S., but also in Europe. And Japan, in fact, has also announced that they're going to double their defense spending over the next 3 years. So there's, I think, pretty good visibility there for companies in the industrial sector. where you might be a little bit concerned about what might be happening to the economy going forward, there's very good visibility for the aerospace and defense companies.
Thank you. Does anyone have any other questions for John or Connor or Doug? No? Okay. Well, we want to thank you for the update on the portfolio and for the, continued long-term relationship and results for the town and the police. Thank you. And enjoy the rest of your summer, and we look forward to seeing you again in October.
Thank you very
Thanks.
much. We will see you in October. It'll be good to be in person.
See you then.
Thank you,
Thanks, guys.
Thank
So
you.
long.
Bye-bye. Okay, so that brings us to item 2 on our agenda, which are the quarterly invoices, which again are more for informational purposes, but are there any questions? No? Okay, so then we can move into the retirement and refund applications. We have some for both the town and the police today. Were there any questions from any of the board members? Or Tony, do you have any updates or any sort of items from your review that you wanted us all to be aware of?
Now, I was able to confirm every one of the calcs that was presented to me, and I was able to match them, so nothing unusual, nothing to raise as an issue.
There
Okay.
is one caveat I'd like to add is it's very light, but we have quite a number of departures from both the Board of Ed as well as retirements and departures from the town. So Tony will in August pre-approve probably 15 plus applications. So we want to get them out on a timely basis. So on your October sheet, half of that, if not more, will be pre-approved by Tony and payments initiated upon his approval that you guys can vote on in October.
Okay. We'll be on the lookout for that. So then as it relates to these, do we have, if there are no questions, then we should vote to approve. Do I have a motion for the town to approve?
I move to approve.
Tony? Great. Do we have a second for the town? Eric, great. All for the town? Wonderful, unanimous. Okay, and then for the police, there are 2 on the police. Do we have a motion to approve for the police?
So moved.
Paul?
That's Kim.
Okay. Oh, Kim, you can second, yes?
Yes, I can.
Wonderful. And so for the police, all in favor? Okay, and that's unanimous. Great. All right, so that brings us now to item 4, which are the minutes. Were there any questions or comments on the minutes from April? No, and then with that, I guess Kevin, you're the only one that needs to abstain since you were not there, but everybody else was. So do we have a motion to approve the minutes
Move to
for
approve.
town? Okay, Tony, Eric, you second, and for the town, so approved. Great, and then for the police, Paul first. Do we have a second for approval from the police? Mike,
Second.
great, and then all in favor? For the
Aye.
police? Okay, wonderful, so that takes care of those. Let's see, so that brings us to the conclusion of our agenda, as I don't believe that there were any other items.
There is one bit of clarification. We left with a question in April about applications that don't come in on a timely basis and our fiduciary responsibility. We have spoken to our pension counsel. Anything will get paid back to the day they started to earn it based on their normal retirement date or the refund date, despite a delay in response. And we're putting some procedures in place to actively seek out those who are approaching normal retirement date, who are term vested, to get those on a more timely basis for those we may not be in contact more often. So we've got that covered.
Wonderful. Thank you for the update and for following up on that. Did anyone have any other follow-up questions on that topic? No? Okay. Well then, I believe that that brings us to a close. If we have a motion to dismiss.
So moved.
All right, Eric and Tony, seconds. Okay, so the town has been moved, and for the police, do we have a motion? Kevin? And second by Paul. Okay. And so we have adjourned. I hope everyone enjoys the rest of the summer. And we'll
Thank you.
look forward to meeting in person in October.
See you then.
Thank
And
you.
it's great, by the way, I love the fact we're all full, I mean, we've got full attendance today. So, great job.
Unbelievable for a summer.
Yeah,
Yeah, that's pretty good.
it is,
Thank you all.
it is. Good feedback. All right,
Thank you.
thanks
Thank you.
everyone.
Bye-bye.
Bye.
Bye-bye.
everyone.